Is it possible to achieve a tax-free retirement? That's what we're going to look at in our video today. Hello, my name is John Vandergriff. I'm one of the owners and the wealth planning team lead at Blue Ridge Wealth Planners, where we help people structure retirement plans, and some of those have the answer to this question that we're looking at today to be yes. Sometimes the answer is no. The real answer is it depends. And so we're going to look at a lot of different scenarios today, trying to assess whether getting to a completely tax-free retirement is possible or not. And if it is, how can we look at maybe a specific scenario of how that can become a reality? So as we look at this, obviously what you bring into retirement doesn't make it good or bad. It's just, it could make it taxable or not taxable. So we're going to look at a few situations here where the first of those is probably the smallest group of people. But if you have a pension, the likelihood of you being able to have a tax-free retirement reduces significantly if this pension is of any size. So if this is a good pension amount on a monthly basis, I would say no, because as we look at this is going to be something we'll refer back to. You've got to look at the way that things are taxable in your retirement. So let's say this person has a pension that is $3,000 a month. So not the biggest that I've seen, but definitely not the smallest. So that's $36,000 a year. But then this person also has Social Security. And so if we're in a position where, let's say their Social Security is $2,500 a month, then they're in a position where the amount of income that they're bringing in is $66,000. And although not all of this Social Security is going to be taxable, the pension is going to result in the Social Security becoming more taxable for this particular situation. So as you look at that, and we'll calculate how we come up with tax on Social Security in our example. The combination of this, not counting really anything else from IRAs or investments or dividends, would result in this probably being a taxable situation the rest of this person's life, especially if they're a single individual, which is what this would look at. If not, then you may have another person in the couple that adds another $1,200, let's say, to Social Security, and almost ensures that this stays as a taxable situation. So again, if you've got now there is a difference here when you look at if you have a pension versus if you have any of those that have a veterans or disability payment. Those are not taxable payments to you. So again, I would say most of our answers here are either no or possible. So if you do have a pension, but it's VA disability, it doesn't show up as a taxable event, possibly be able to get to there. You'll see some of the way we try to answer those possible scenarios. But again, plain Jane pension where all of it's taxable, most likely you're going to be in a taxable event or situation for the rest of your life. Now, if you have taxable income from investments, this can result in a problem because if it's of a sizable amount, or depending on where it comes from, it could make it to where you are taxable for the rest of your life. So as you look at this, obviously taxable investments are going to be broken down into, dividends and interest, which would be income taxable, capital gains, which until they are realized are not taxable. So I'm actually going to draw the line at here at no or possible. And then real estate. So like if you've got rental properties, you can do some things with the taxation of that and depreciation to make it less taxable for a time, but at some point you're going to run out of depreciation, and then all the income you get here will be income taxable to you. So the possibility is if you have all investments that pay zero dividends and interest, and you have capital gains that you never realize in your lifetime, possibly. You could possibly get there, but that means you've got a chunk of your money that you're not really touching for an extended period of time, and it's all growth oriented with no dividends or interest being collected. So, because again, the more that these things accumulate, the more that those dividends and interest become a taxable event, it could result in Social Security being more taxable to you. And then if that total as Social Security plus those dividends and interest gets above your standard deduction, then you get into a picture where you would have a taxable event. So one of the ways that you look to do this is trying to reduce some of the taxable money you have. People will say, oh, well, let's forego that and get to a point where we have just our IRAs. Well, that will be a problem later in retirement when you hit RMDs. So now, if you only have Social Security income, it is possible to have a tax-free retirement because of the way that Social Security is taxed. And most people don't understand this. Most people think everybody's Social Security is taxed. It depends on a combination of factors, because basically the way that Social Security is taxed today is they are going to take half of the amount that you're receiving from Social Security plus any other taxable income that you have. And as you add those together, if you are single versus married, you'll have two different thresholds that will calculate the taxes here. So if you are under $25,000 for a single person or $32,000 for a married, you will not pay tax on Social Security. And if Social Security income is all you have and you really don't have anything else, you may not need to file a tax return because you won't pay taxes on the Social Security income. Now, if you are between, in this case, $25,000 and $34,000, and then $32,000 and $44,000, then both of those are situations where half of the amount that's in that threshold would be taxable. Okay? Now, once you get above $44,000 as a married couple and then $34,000 as a single person, 85% of the amount of your Social Security above that would be taxable, with the maximum amount of Social Security being taxable today at 85%. So worst case, if you've got a ton of money, you got Social Security, you're getting $2,000 a month, $1,700 of that is going to show up as taxable to your situation. It is not taxed at 85%. This is just the percentage of that Social Security amount that will show up as taxable. So depending on how your income is structured outside of Social Security will determine how you progress through these different thresholds. So that's important to note because there's some things that you can do actively in your retirement to try to manipulate how the taxation of your money shows up. Now, you say, well, what if I have IRAs or 401ks? Unless you just don't have very much in there, I would say the answer is no, because of the government's decision to make you take required minimum distribution, or RMDs. Because this is looking at your situation, you're going to have starting a little less than 4% of your total balance at 73 today. After 2020 or after 2033, it would be 75. But basically, every year that you pass, that number is going to be increasing. So maybe you start out at RMDs and you're not taxable, but once you progress and let's say you get to 90 and you're taking out almost 10% of your account every year, you probably are in a position where you're taxable at that point when combining this with Social Security and other income pieces of your portfolio. Because the danger with RMDs, even if you don't need this money, the money having to come out is going to force you to have at least two different buckets, right? So like you have RMDs because you have an IRA or a 401k, but once you cross into this window, you will still have some money that moves forward into an IRA, but unless you spend this money, that's going to force this money to go into after-tax dollars, and then every year that money will start to show up as a taxable event of some type for the rest of your life. So as we look at this, let's say your IRA is continuing to grow. What that will mean over time is if you're not spending this, this bucket will continue to grow and your whole situation will start to become more taxable. So that's where, for most situations, the answer is no. Could you show me a one-off scenario where this person doesn't pay tax? possibly, but it's usually going to mean you're taking a really small amount out of the IRA or 401k, even considering your RMDs. Now, if you convert the IRAs and 401ks that you have to a Roth, that is another possible situation to get tax-free, and that's what we're going to dig into in this video today with this specific example. And sometimes when we do these videos, people say, oh, that's not realistic. This is a client scenario that we have in our company that we've worked through. I'm obviously not giving any pertinent details to see who this person is, but this is one that we're actively working through, trying to get this person to an eventual state of tax-free in their life. So let's look at the scenario here. So we've got a client situation, a married couple, one is 68, the other is 64. So important things to note here with the money that they have in 401ks, which is all in this spouse's name. They basically have 5 years before RMDs kick in, where they have forced distributions on the 401k. One of their goals is to try to be as efficient with this money as they can from a tax perspective. So we're trying to target not having to deal with RMDs, which means we'll have to do some sizable conversions here. But currently, they're bringing in part-time wages of $40,000 a year. They have no debt, so therefore their lifestyle needs generate $5,000 a month or $60,000 a year. So you say, how in the world can they make it work? Well, again, they accumulated when they were working, they paid off their debts, and now they're in a position where they can live, below what most people would consider their means. And so as we look at this, the things that we have to factor into the scenario here, Social Security is coming along at 70. So again, game plan here would be this spouse would stop working once they get to 70, roll on to Social Security. So we would factor into their plan that. And then this spouse did not work outside the home, so they are eligible for spousal benefits, but not until this spouse takes. And if they waited until full retirement age, they would be able to get $1,800 a month as a spousal benefit. So as we look at this, longer term, they're going to get technically a raise in retirement from Social Security. Our job is to try to see if we can take that total and lower it to try to get them into a tax-free situation overall. So $800,000 in 401k dollars. They do have $300,000 in after-tax. So today they're supplying their income need in a mixture of some 401k pools, but also after-tax. So as we look at this, just so you can see a breakdown here. So this is 2024 tax brackets. They are in a standard deduction situation, so they do not have high deductions. So this year they will show $62,000 of taxable income. And if we were looking to do Roth conversions, they were in a position where $61,500 would be what they have remaining in the 12% bracket. And then another $106,000 would be the top of the 22. Some people will bring up, won't they cross into IRMA thresholds? They would. So that is something that we've got to factor in, but they're not currently concerned about that because even though they're working part-time, this deal with the current employer still allows them to have access to health insurance. So he could continue to work if IRMA got to be an outrageous thing if he so chose. So as we look at this, if we were in a position where this allowed them to do $168,000 a year of conversions on $800,000, depending on the growth rate, and obviously time will tell how much that bucket grows. But today, if this is the total we converted, they would have about an 18.3% effective tax rate on this conversion. And then these dollars would move into a Roth position and be able to grow tax-free as they continue to accumulate in retirement. And if we did this each year for 5 years, the goal would be that that $800,000 pot, as it gets moved over, is still growing, but less aggressively, hopefully in the 401k, more aggressively inside the Roth bucket, but hopefully getting them to a point where they're at a net zero 401k when most people would take RMDs at 73. So again, with the factors we know, obviously you would have some inflation adjustments that may factor into Social Security, but if they were in this position now, so $5,800 a month of Social Security income would be $69,000 a year. So let's work through our example of how their Social Security would be taxed. So half of that total will be $34,800. If we added, and let's assume they had $10,000 of dividends and interest, that would be the other portion of their taxable income. They're not pulling anything out of their Roth, so there's no taxation there because they're bringing in more money than what they're consuming right now. Even with inflation adjustment, I think that would be true. So in this particular situation, their total to consider from how Social Security would be taxed is $44,800. So again, they're above these thresholds. So obviously they're above zero on Social Security. So you say, how in the world are they tax-free? Let's move to our next page to solve that. So the amount between 32 and 44 would be taxed at 50%, and the amount that's over 44,000 would be taxed at 85%. So as we look here, let's take that 44,800. We have $12,000 of the Social Security that's taxed, or 50% of it's taxable, so that would be $6,000. Then we have $800 above that 44,000 threshold that's taxed as, or 85% of it's taxable, so $680. So their taxable portion of Social Security is $6,600. So less than 10% of their overall benefit is taxable. So we look at that and you say, well, that still shows up as a taxable income. It does. So if you factor that in, Social Security would show up as $6,680. The interest amount would also go with that at $10,000. And if we use today's standard deductions, because we don't know exactly what they will be 5 years from now, but at $29,200 of standard deduction, this $16,000 and change is not enough to clear that. So guess what? They do not show up with a taxable income. So this couple, even though they're living a lifestyle off of, maybe at this point $70,000 a year, they're showing up to the table with no taxation on any distributions they take or on Social Security, the way that Social Security is structured. Now, the thing that you've got to throw in as a little bit of a caveat with the way that Social Security is taxed. So this calculation, and even the one we used for single, has not been updated for inflation since Social Security became taxable in the early 80s. So is it possible that their income from Social Security could get high enough to make them taxable? Possibly. But if they were in a position where that happened, then we would do some things to try to adjust and make it to where they could get some deductibility on those dollars, either by increasing above the standard deduction to make things tax or less taxable, or there would be some strategies that we could utilize to try to get them there. So as we look at this, that's why we say it's possible. It's not guaranteed really in any situation, because we could have rules in place now and the government could change those rules drastically and make any tax planning strategy that you look at today look worse or better depending on how those rules affect you. So the key here, going back to our situation, anytime we walked with or talk through somebody's situation, we don't just look at taxes, we don't just look at income. You got to look at the whole picture combined, because again, how you make investment decisions will affect your income. It will also affect your taxation. We also need to make sure that we're paying attention to impacts to healthcare situations. And then also for family legacy, one of the motivations for this couple, because you said, well, gosh, these people have such low income, why don't they just ride it out and not pay any taxes? Their main concern for the 401k dollars that they had built up today was to get their position in a Roth, which gave them tax-free flexibility while they're living, but also a 10-year tax-free bucket that their children could have access to when they pass away for tax-free accumulation. So again, for them, they look at it and say, well, gosh, this is going to be more tax than we would long-term pay, but we feel like this would be less taxes than our children would have once they inherit these dollars. So again, you've got to look at the total picture and not get so wrapped up in the details of today and this person's individual situation, but what you're trying to accomplish as a whole and how does that fit into the overall decision-making process. So if nobody's ever walked you through this, I would encourage you, there's a link below this video. You can click that link, schedule a time with us to see if we can help you find a way to get to tax-free in retirement. The answer may be yes, no, or possible. But again, we won't know that until we talk to you and see what you have in your situation bringing to retirement and how those positions could be leveraged to try to get you in a better position overall. So with that said, hopefully you learned some things. Let us know if you have some questions in the comments below. If you think that this is applicable, or if you start to have conversations with people and they start talking about taxes, share this video with them so that they can get better educated, and maybe we can help them in some variety, and maybe we can help you. But with that said, thank you for your time today. We look forward to releasing more content like this in the future. And yeah, stay with us and subscribe and see what we can do for you.